Hello, welcome to Principles of Accounting 2010, Chapter 8 videos. In video 3, we are going to be looking at the last components of analyzing our accounts receivable and estimating the bad debts. And in video 3, we are going to be looking at the most precise and perhaps the most accurate way to analyze those receivables which we may never collect. And that is called the the aging of receivables. And this is the most often used and looked at in accounts receivable. In fact, if you start out in accounts receivable in your first accounting job, the aging of the accounts receivable may be a position that you would have. And in the aging of accounts receivable, we are going to be looking at every person who owes us money, how long have they owed us the money, and what is the likelihood that they will pay us. So this is an example out of the textbook, and what it has is a chart of the accounts in the subsidiary accounts of all of the people who owe us some money. And so we have our customer names, the Broxson, the Phi Chi or Phi Chi fraternity, Andrews Jones, other accounts. And it breaks it down by how long they've owed us money, 1 to 30 days, 31 to 60, 61 to 90, and so on. And the longer that they owe us money, if you will see, the more unlikely it is that they will pay us. So in the folks who have owed us money between 1 and 30 days, we estimate that there's a 99% likelihood that they will pay us, or a 1% chance that they won't. So we take that 1% times the total amount, and we say that of the 1,860 owed to us, there is a 1% likelihood that they will not pay us, and that $19 may never be collectible. Then the older that the account gets, 31 to 60, we raise that likelihood of non-payment to 2%. If it's due within 61 to 90, we raise that likelihood to 5%. And over 90 days, we believe that there's a 90% likelihood that we will not get paid. Often we may be turning them over to a collection bureau or selling these accounts receivable for someone else to collect it for us. But the longer that people owe us, the greater the likelihood they will not pay us. And by analyzing each account, we should come up with a pretty good estimate of which will not be collectible. So if we add the 19 from those that are 1 to 30, and the 4, the 17, and the 360, we believe of the $2,800 owed to us as of December 31st, 2014, 400 of it will never be collectible. And so this gives us a very accurate assessment of the collectability. So like the percentage of receivables, we are going to be looking at what is the account receivable total and what do we expect not to collect, 400. And then we will be setting up our accounts. So there's the 2,800, and our allowance, if we had a previous balance of 150 in the allowance account with a target balance of 400, we're going to be trying to see what would be the bad debt expense to reach that targeted amount. And so if we had 150 already existing in the allowance account, just as we did with the percentage of receivables, but with now a new target of $400, the expense that would need to reach that target would be $250. 150 plus 250 would give us the $400. That $250 would be the bad debt expense that we expect to incur as a match to the $2,800 that is owed to us. So it is a very similar method. And then when we can actually identify who, as we had demonstrated in previous problems, who will not pay us, we will take that amount out of that allowance account, that amount that we had estimated and set up, and then we will write off the specific accounts as they would become uncollectible. The last method we're going to talk about in this chapter is the direct write-off method. And the direct write-off method is a method which is only used by very small businesses, perhaps large business if they have very few accounts receivable. And in this method, we are so closely able to track our customers, and we have such tight credit policies that we are not going to be setting up an allowance account. We will simply write off the account when it is, or when it becomes uncollectible. And we're not really violating any matching principal when we are able to very closely monitor these, and the amount is so immaterial that we do not collect that it would not influence creditors or investors in their willingness to invest in us or to lend us money, because we have such tight credit policies that uncollectability is not, or uncertainty of uncollectability is not a problem for us. So the problem with the direct write-off method is that it could potentially overstate the account receivable on the balance sheet if we don't have an allowance account, if for some reason our calculations, our estimations are not accurate. So if we have on the balance sheet of the full accounts receivable without any offsetting allowance account, and we do have folks who do not pay us, it may overstate our accounts receivable. And so we say that it could potentially violate the matching principle if we are not making those estimations. So that ends Chapter 8 in the accounts receivable. The estimations, we've looked at the income statement approach, which takes a percentage of sales, and we do not have any regard for any balance in the allowance account. Then we look at the balance sheet approach that looks at the aging of accounts receivable, where we assess each individual account for its collectability and make an estimation of that those accounts which will not be collectible. The percentage of receivables, which takes the ending balance and estimates a percentage that will not be collectible. And in either of those balance sheet methods approaches, we will be looking at the allowance account and taking in any existing balance into account, whether it is a debit balance or a credit balance, and making adjustments, and that will be our bad debt expense, as is necessary to reach a targeted amount.